Jamie, I got a question for you. How did you pay an effective tax rate of only 10% in 2023 and legally?
Yeah, military service members have a huge advantage when it comes to taxable income because a large portion of our pay is just not taxed. So today we'll talk about how this works, how to calculate your effective tax rate, how the U.S. tax brackets are designed, and how this affects investment decisions for your situation, including the Roth versus traditional decision.
Welcome to the Military Money Manual podcast, where every episode is all about achieving financial independence in the military faster than before. We believe personal finance shouldn't be boring or intimidating. Building wealth can be simple, and financial freedom is the ultimate financial goal. Now, here's your hosts, Spencer and Jamie.
Hey everyone, welcome back to the Military Money Manual podcast. Spencer Reese here from militarymoneymanual.com. Today, we're talking about taxes. Not the most exciting topic, but it's relevant because you have a job, you're in the military, and you have to pay taxes. And really, what we're just going to try to do today, this isn't going to be a super deep dive into the U.S. tax code. It's really just explaining some high-level concepts so that we can dispel with a lot of the misinformation and a lot of the misunderstandings that people have about the tax code. There's a lot of, what do you call them, like dorm CPAs or dorm attorneys out there that are like...
Barracks lawyer, I think.
We're a bit of barracks lawyers ourselves. We're at least a little bit more informed than some jabronis out there. So here we go. We're going to talk about some U.S. tax code and how it applies to your military pay. Jamie, I think the best place to start is the tax advantages of military pay. So in the military, we have an extremely low taxed income. So like the amount of money that you receive, a lot of it is not taxed because allowances are not taxed. And that's before we even get into CZTE, combat zone tax exclusion pay. So some of the allowances that aren't taxed: BAH, basic allowance for housing; BAS, basic allowance for sustenance; OHA, overseas housing allowance; overseas COLA; hostile fire pay; imminent danger pay, because you're presumably receiving CZTE as well; and then CZTE, combat zone tax exclusion pay. And that's determined by where you're stationed, deployed to, or TDY to. And some allowances, like the new basic needs allowance, are taxable. So that's getting a little confusing there, because usually we could just say that all allowances aren't taxable, but I guess that one is. But very few people are going to qualify for that basic needs allowance. And then bonuses, of course, are regular taxable income unless you receive them in a combat zone. We'll talk a little bit more about that in detail coming up. Continuation pay, career field bonuses, all those bonuses are usually taxable income unless you take them in a combat zone, and then they're untaxed.
Yeah, so in general, like you said, it's just a great starting point for us because people think they see a gross salary for their military pay and say they're making $90,000. That doesn't mean you're taxed at $90,000. And when you look at how it compares to your taxable income as far as the IRS is considered, your adjusted gross income is usually way less than what it is normally on your LES or what you calculate in your spreadsheet because of all those allowances. That's a huge, huge win for military families.
Just wanted to double click on the CZTE combat zone tax exclusion area. So I saw this on Reddit the other day. Classic. A guy was getting sent TDY to the United Arab Emirates, and he was trying to argue with his command that his commander was basically saying, well, you're not serving a combat role, so you're not going to be eligible for combat pay. And everybody on Reddit was like, dude, that's not how that works. Like, those areas are designated by the president by executive order. If you go to irs.gov/individual/military/combat-zones, we'll put that link in the show notes so you don't have to frantically write that down as you drive into work. But they have a list of all the designated combat zones, the current recognized combat zones there. And currently it's the Sinai Peninsula, Afghanistan area, which probably a lot of people aren't getting anymore. Kosovo area, which is still designated since 1999. Thank you, Bill Clinton. And the Arabian Peninsula area has been designated as a combat zone starting in 1991, and that includes all of the Persian Gulf, Red Sea, Gulf of Oman, Iraq, Kuwait, Saudi Arabia, Oman, Bahrain, Qatar, and the UAE. So a lot of those areas are extremely safe. Probably you're not going to be engaged in active combat if you're stationed in the United Arab Emirates. I lived there for 2 years. It was incredibly safe. But yeah, it still counts as a combat zone. So don't assume just because you're getting sent TDY and you're staying at the Ritz-Carlton in Abu Dhabi or Dubai or Bahrain that you're not eligible for combat zone tax exclusion pay for that month. And for enlisted, there's no limit on the amount of money that you can receive in a combat zone, and it's not taxed. So that's extremely beneficial for enlisted service members to elect to receive bonuses in combat zones, because the entire bonus then will be untaxed. But for officers, it's capped to the highest enlisted monthly pay, and then only that portion of your pay can be CZTE untaxed, and then the remainder above that is taxed at your normal rates.
Yeah, and it's a little bit of a misnomer to call it CZTE pay, because it's not really another pay on top of your pay. It's really just the tax benefits of your existing pay, although there are some other things that kick in, like hostile fire and imminent danger pay potentially, but it's not a separate pay. You'll never see CZTE pay on your paycheck. But as we look at the taxable income in the tax brackets, I ran a couple examples here I'm going to run through, and I'll do my best to spell them out for you, for the listener to follow along, just to show you the difference between what you're getting on your LES and what the IRS is considering as your taxable adjusted gross income at the end of the year. First one is an E5 at Holloman Air Force Base in New Mexico, single with greater than 4 years of service. Their base pay will be around $40,000. It's $40,388. BAH is $12,500 basically. BAS is $5,500. That means $18,015 is non-taxable of their pay. Then you take the standard deduction, which for a single person right now is $14,600, and that makes their taxable income of only $25,788. So $26,000 of taxable pay compared to their base pay that we started out with, $40,000 plus BH plus BAS. And then that taxable income of $26,000 is what the IRS is going to see, which is crazy.
There's this great calculator, Jamie, I like to use. It's on MoneyChimp, moneychimp.com. And you can just search MoneyChimp tax calculator and it'll come up. Again, we'll put the link in the show notes. But dropping $40,000 of taxable income into the MoneyChimp tax calculator for a single person in 2024, you're going to be paying about $2,800 of taxes. So that's $2,800 of taxes on $58,000 of income that person's receiving in a year. And again, only $40,000 of that is taxable income before you take the standard deduction, and that knocks it down to under $26,000. So if we take that $2,863 of taxes, they're paying a 4.9%, we'll call it 5% effective tax rate, Jamie. And that's pretty standard across the board. I mean, even as a officer, when I was in the Air Force as a well-compensated Air Force pilot, I never really saw an effective tax rate over 10%.
Let's look at another example for an E7 stationed at Fort Sill in Oklahoma. In this example, we'll use married over 16 years of service with 2 children. Their base pay for this E7 will be about $66,000, BAH $17,712, BAS of $5,500, and that means that $23,000 of their pay is not taxable, plus their base pay $66,000. You take away the standard deduction, which right now is $29,200, and that means their taxable income is only $37,187.
So again, Jamie, running the numbers real quick on this, $66,000 of regular taxed income minus the $29,000 approximately married filing jointly standard deduction. You're looking at only $37,000 of taxable income, like you said, and that's $3,999 of taxes paid. But we just mentioned that they have 2 kids as well. And what's the child tax credit this year?
It's like $3,000 a kid, I think.
Yeah. So there's another $6,000 Uncle Sam's thrown at you just for having some kids. So now you're looking at a tax refund of $2,000. So you have a negative effective tax rate.
Simple examples. We're not, there's no property taxes, there's no qualified dividends, there's no investment income or inheritance or anything weird like that. But a lot of our military families are very standard in their taxes. Regular W-2 income, sometimes only one income is the military W-2, but even if you have another income from your spouse, you can still run another calculator like the MoneyChimp calculator and see that your benefits are huge. And so in this case, oh, by the way, you take your $4,000 tax bill that the IRS says you're going to have, you forecast it out, you divide that by 12, that's the amount that you should be paying in taxes each month on your LES. all else things, in this example, there's no other variables in there. So you can run calculators and figure out if they're taking $400 a month out of your taxes and you're getting a refund of $2,000 at the end of the year, then you probably can adjust that to where they're not taking out so much of the taxes out of your paycheck.
Yeah, that's a great thing, Jamie, to just increase your monthly take-home pay is just get your exemptions right. And there's lots of calculators out there that you can use to figure that out. People love to brag about the refunds they get at the end of the year. And there's some things that you just, like if you've got child, even if he cranked up in this example, his exemption so that he was having no withholdings every paycheck, he's still going to get a refund at the end of the year because of the child tax credit. And that's fine. You can't control that. But what you can control is, like you said, if you're paying $400 or $500 a month in taxes and you're getting a massive refund at the end of the year, why don't you save everybody the pain and get your paycheck dialed in? And then that's an extra couple $100 in your pocket. And then you're not giving an interest-free loan to Uncle Sam.
Yeah. More importantly, who wouldn't want $400 extra or $200 extra a month to spend, whether it's on groceries and, helping with the cost of milk or gas or whatever it is, or just being able to save for a vacation faster. So let's look at another example. 03 at Wheeler Army Airfield in Hawaii. I think we're getting most of the branches here. Married with one kid and over 6 years of service for this captain in the Army. Base pay of $86,000, basically just under $86,000. BAH of $49,400. BAS $3,800. So that totals up to $53,200 of not taxable income with their allowances. I don't even have COLA calculation on here, by the way, minus the standard deduction of $29,200, and that gives their taxable income of $56,393.
Just running the calculator here real quick, Jamie, I'm looking at probably $6,300 of taxes that they're going to owe, but we can subtract out the kid, so that knocks it down to $3,300. And how much total compensation are we looking at? I mean, they're making over $100,000 a year here. So this captain, Jamie's making over $138,000. And we didn't even include COLA in here. So you could probably add another couple, I don't know, what's COLA these days, but
$600 a month maybe or so.
Yeah. So that could be, another, let's call it 140, just as a rough estimate. So they're paying $3,300 on $140,000 of income, a 2.3% effective tax rate.
And that's not even deployed pay. That's not no combat zone.
No. And actually, this is a good argument in favor of not deploying, right? Like if our effective tax rates are this low anyways.
The thing that gets you for overseas, like Hawaii, his BH is so much. So the captain, a lot of their income that's not taxable, $50,000 a year in this case for her BH. And so that's going to skew the numbers a little bit for your effective tax rate, but that's kind of why it looks so different. But $3,300 in taxes for this is insane. And just a couple other quick examples here. An 05 in Hawaii with 14 years and 3 kids. That's where I was a couple years ago, still in the 12% bracket because 33% of that 05's pay was not taxed, which is it's just insane to understand the benefit of the way that military pay is taxed.
So you were the 12% bracket, but your effective tax rate was even lower than 12%.
Yes.
Awesome. Wow.
Effective rate was closer to 10. And then if you look at an E5 at Naval Station Great Lakes, married with one kid and over 10 years of service, they're in the 10% bracket. Almost 40% of their pay is not taxable income. So the first thing we want to leave with you is it's really important to understand how much of your pay is not counted as income when it comes to the IRS and what's actually reported as taxable income. So most of those allowances we talked about, which are primarily BH, BAS, and then overseas COLA. And then Spencer briefly mentioned bonuses earlier. So bonuses are withheld initially at 22%. That does not mean you'll be in the 22% tax bracket. We'll explain in a minute about how exactly the brackets work. It could be higher, could be lower. It depends on what your income actually ends up at the end of the year. But just because they withhold 22% on your bonus or continuation pay or anything like that does not mean you'll actually be in the 22% bracket.
Just a quick note from one of our sponsors, and then we'll be right back to the show. Hey, Jamie, we got a lot of great people out there listening to the podcast. Any resources you'd like to point them to continue the education on financial independence in the military?
Yeah, if you're getting value out of this podcast, but you just want a little more detail or some more practical steps, you got to check out the Military Money Manual book by Spencer Reese, A Practical Guide to Financial Freedom. In here, Spencer laid out everything that he wished he had been told when he first joined the military, and it's going to help you build wealth and take advantage of your benefits while you're serving on active duty or in the reserves or in the Guard.
The Military Money Manual is available on Amazon, Audible, and my website, shop.militarymoneymanual.com in hardcover, paperback, ebook, Kindle, and audiobook. Podcast listeners are eligible for a special discount by using promo code PODCAST when you purchase the Military Money Manual on shop.militarymoneymanual.com.
So Spencer, help us understand, how do we actually calculate our effective tax rate? And then we'll look at how the brackets work out.
Yeah, so the easiest way to, in the way that I've been doing this, Jamie, just on the fly right here, while we've been talking, is you just take your total taxes paid. So it's easier if you can do it for last year because you'll have your IRS form 1040. And you can just go look at your 1040 and you can just look at line 15. That'll have your total taxable income. But in the military, as we've just been talking about, that's not representative of all the income that you've actually made because so much of your income is untaxable. And, we haven't talked about per diem and TDY yet, Jamie, but that can be a substantial source of income for a lot of service members. And again, it's not treated as taxable income by the IRS. It's treated as what it is, which is a reimbursement for travel-related expenses. My wife and I, when I was going TDY a lot, we would save and invest off of my regular paycheck, and then we would just spend all of my TDY money when it came in as our fund money. Like that was our fund money bucket. So that could be a significant source of income. And I'm not saying you have to go out and calculate and add that all up, but just think about it next time, especially if you're someone who goes TDY a lot. Okay, so line 24 on your Form 1040 has your total tax bill. So that's what you owe that year, what your total tax amount was for that year. Let's say, for example, you had $123,000 of total income for the year. And you're going to want to look at not just your taxable income, but you're going to want to look at your BAH. So really the best thing I would do is just go look at your LES for December and see how much each category is and then add that all up. Because in the military, we can't just look at our taxable income. That's not a true representation of how much income we actually make. And then take that tax number, that line 24, divide it by your total income for the year, and you'll get a percentage. So like in the example one of the examples that we have here, let's say you had $123,000 of taxable income or total income. So that's BAH, BAS, basic pay, all of your income sources from the military. And you paid $12,000 of taxes. So you divide $12,000 into $123,000 and it's about 10%. And that's your effective tax rate.
Yeah, I didn't even think about, Spencer, that's a really good point about how your effective tax rate really should include all your non-taxable pay. So when I talk about my tax rate being 10 or 12% in the past, it's really what effective tax rate is going to be way lower than that in the single digits then for sure. But you can use all these numbers to make an educated guess on this year's or next year's taxable income, and then use the brackets to make an informed decision about what you want to do. So in general, the U.S. tax brackets, and we're talking about income tax brackets here, there's some other ways you're taxed that are slightly different. But to keep it simple, we're going to focus right now only on income tax brackets. So as of 2024, these might go back up next year. I'm just going to give the percentages first because charts are kind of hard, but we'll post an image link to Jeremy Schneider or some Personal Finance Club hit on the tax brackets. But there's a 10%, 12%, 22%, 24%, 32%, 35%, and 37% brackets. And I would venture to guess that most military families fall somewhere in the 10%, 12%, 22% brackets at the most, with a lot of them being in the lower brackets. So Spencer, walk me through what it means to say that I'm in the 12% bracket. Does that mean every penny of my income is taxed at 12%?
No, absolutely not. And, I think that's a bit of a misnomer too, because a lot of times military service members are looking at, even if they understand that BAH and BAS isn't included in their taxable income, they're probably just looking at their base pay times 12, which isn't a true reflection because it doesn't take into account at least the standard deduction. If they're lucky enough to be in a position where they're itemizing, then it's not taking into account the itemized deduction. And it's not taking into account any credits they might receive, like the child tax credit, which is pretty common for a lot of military families. So if you're looking at this, you're like, oh, I'm in the 12% bracket. It's like, okay, cool. But the way that our tax system is set up is it's a progressive tax system. And what that means is that the more you make, the more you pay. So in the first bracket, 10%, all your pay goes into that bracket first and fills up that bracket before moving on to the next bracket. So if you make, let's say, $100,000 as an example, nice easy numbers. The first $11,000, or to be exact, $11,600 if you're single, is going to be taxed at 10%. So the first 10% of your $100,000 is taxed at the 10% rate. So that's $1,160 of taxes. Then starting at the next dollar, the $11,601 up to the $47,150th if you're single, you're taxed at 12% for all the dollars in that bucket. And then it spills over to the next bracket, to the 22% bracket, where the dollars that you make between $47,000 approximately and $100,000 approximately are taxed at 22%.
But again, that's after the standard deduction right now, right? So if you're in 2024, if you're single, the standard deduction is $14,600. So if someone only made $14,600, like say a teenager, and they're working at McDonald's or something, they make $14,000 that year, their standard deduction will wipe out all of their income to a 0% bracket or 0% rate.
So there's two ways to think about it. Like in your example, right? If a teenager made $10,000 working at McDonald's and their standard deduction is $14,000, then all of their income is wiped out. They'll pay 0% in income taxes. They'll pay other kinds of taxes, but we're not addressing those.
And this is federal too.
And this is federal, right? We're not talking about state. We do have a podcast episode about state income taxes for military service members. You can search the podcast and you can find that. But the other thing is, if you make $100,000 and the standard deduction is, let's say, $14,000, you can just take 100 minus 14, 86, and then you can start doing the brackets based on that $86,000. The other way to think about it is that deduction takes away the dollars from the highest bracket. So you can think about it like, let's say you got $100,000. Okay, we're going to fill in that first bracket that goes up to 11,600. Then we're going to fill up that next bracket. Then we're going to fill up that next bracket. But because of the deduction, we get to shave off the last $14,000, which is at the highest marginal rate, right? Which is at that 22% rate. So that's a nice feeling, right? You're saving taxes at the highest possible rate thanks to the standard deductions.
Okay, so in this case, a portion of their pay will be taxed at 0, portion at 10, portion at 12, and a little bit at 22, depending on how you think of it, like you said. And this is for someone that's single. If you're married filing jointly, everything effectively doubles. It's not quite exactly double, but it's pretty close to double. So if there is, say, a one-income military family married filing jointly where the spouse does not take in any extra pay and they make $100,000 a year, their current standard deduction would be $29,200. So you can take it down the way my mind works, at least, is take that down to basically $71,000. And then you'll get 10% bracket and a little bit in the 12% bracket. So up to $23,200 in 2024 is the 10% marginal bracket, and then 12% would be the $23,201 up to $71,000. So not all of it is at 12%, just a portion above. You fill up the 10% bracket first, and then the rest of it's at that next bracket.
Yeah, so this is when people talk about like there's a tax advantage to getting married. This is what they're talking about, right? So let's say you have a single Air Force officer making $100,000 a year. If they're single, they're going to pay $13,800 on their $100,000 of income. So 13.8% effective tax rate. If they're married filing jointly, though, so they get married and their spouse doesn't work, so they still make $100,000, they get to take the higher deduction. And so now they pay $8,000 in taxes, or 8%. So you're saving almost $5,000 in taxes annually just for getting married. And that,
so everyone go get married, move out of the dorms, and save money on your taxes. No,
yeah, exactly. So
just kidding.
And that
Don't do that.
That doesn't include dependent BAH too, right? So There's definitely an economic incentive, whether that's good or bad. Indifferent. I'd probably argue that's probably bad, but there is the way that our system is currently set up is you have a tax advantage to getting married.
And if your spouse is working, just take their pay, because it'll likely be all taxed, or whatever their military pay is if you're a mil-to-mil couple. You take their taxable income plus your taxable income and combine it to figure out what your bracket is. And then, oh, by the way, the highest tax bracket right now is 37%, which is overall historically low for as far as the max tax brackets go. So the dollars amount or the percentages might change, but the 37% maxing out is historically low right now.
That is correct. I hope people don't get too hung up on the tax brackets. Like, it doesn't really matter. Like, you shouldn't ever not take a bonus because you're afraid about moving into a higher bracket. It does get a little bit weird in the very low brackets where there's like earned income tax credits and there's savers credits and stuff. Like, there could be some advantages to like keeping your income artificially low in the extremely low brackets. But in general, like,
it's a privilege to pay taxes.
Yeah, exactly. It's okay. It's okay to pay taxes and to move up the brackets. And especially in the military, it's very hard to get into those higher brackets. We don't have any examples here, Jamie, of dual military, but again, because of the BAH factor, I mean, you could have a dual military, 03, 04 couple stationed in Hawaii, and they're making $300,000 a year total compensated income, but their taxable income is down in the 22% bracket. And then that's before they get child tax credits and the standard deduction and everything. And all of a sudden, before you know it, they're knocked down solidly into the 22% bracket. And their effective tax rate is probably under 10%.
So there's no one size fits all answer to this at all, but how might some of this understanding of the tax brackets affect our investment plans? I think immediately, at least, Roth versus traditional and how this knowledge of how much of my pay is not taxed into the decision of will my tax bracket go up or not. So if you're making $100,000 when you separate the military and you go get a civilian job where you're making $100,000, it's going to feel like a pay cut because 30% of your taxes or of your paycheck that wasn't taxed will now be taxed. So you're going to have that hit. So even if you're not expecting like a big boost in retirement or in your post-military life, if you separate or whatever, you really got to understand how that amount affects your tax rate. So for most people that are going to get out of the military, whether at retirement age or separating after a term or two, your tax rate will probably go up, in my opinion, because if all else stays the same, all of your pay is going to be taxed, and hopefully you get a job that pays somewhat equivalent.
I think in the Roth versus traditional debate, Jamie, it's pretty easy. If someone tells me that they're collecting a military paycheck, Roth IRA and Roth TSP, I almost don't need to know any additional information unless they're married to like an NFL player or a doctor, not just like an ordinary doctor. I mean, like a really good doctor who's making a lot of money. And this is one of those things where like, don't step over dollars to pick up pennies, right? Like, don't get so far into the forest that you can't see the forest anymore for the trees. If you're maxing out a traditional TSP and a traditional IRA, and it was more advantageous for you to do a Roth TSP or a Roth IRA, that's okay. Like, you just saved $30,000 towards your retirement. That is far more than most Americans ever save towards their retirement. Okay, maybe you quote unquote got it wrong, but that you really didn't, because you set that money aside. It's going to grow. It's going to compound. You've invested it for the long term, and your future self is going to be very thankful to you, even if you probably should have gone with the Roth option. And that's kind of my default answer. If you're in the military, unless you have a very good reason, you've actually done the spreadsheet, and you've done the math, or talked to a CPA and accountant or a financial advisor and figured out, should I do Roth or traditional? Roth is the easy answer. Roth IRAs, Roth TSPs. Even if you are, dual income and you're afraid that you're going to get pushed out of the Roth income contribution limit, which I think is like over $200,000 for 2024. Yeah, it's over 220,000. I think it's 228,000. That's only going to go up because I think that's indexed to inflation. So again, pretty rare that if you're in the military and you have a very high earning spouse, that you're going to get pushed above that contribution limit. But if you're getting close to it, just do a backdoor Roth IRA, and then you're fine. And again, if at that point you can't make deductible contributions to a traditional IRA anyways, so you're out of luck. So just make contributions to your Roth IRA via the backdoor. And you can Google that. It's not that complicated. I've been doing that for a couple of years now. And on the TSP side, if you're in that situation where you're starting to do backdoor Roth IRA contributions, maybe traditional TSP is a better option for you. And it's okay to have a little bit of diversification, tax diversification too.
But there is no income limit for Roth contributions in the TSP, correct? So if you're phased out for income in other products like your IRAs, you can still do Roth TSP if you want. We're pretty bullish on Roth right now. Don't buy a house on active duty and contribute Roth are kind of our latest talking points that we're getting a little passionate about. But there are resources out there that can really crunch numbers in detail for you. Another one I'll plug is the Military Tax Experts Alliance. And it's kind of like the MFA, the Military Financial Advisors Association, where it's just a group of military associated, affiliated veterans or spouse types who are tax experts, EAs or CPAs, and they can help you with your tax situation, usually in whatever state you are. You go to that website and you'll find a number of people. You can figure out which one you like the best and interview them and things like that. And then the last plug I'll make is it's a good idea to track this on your LES. So right now we're recording this in November of 2024. So I'm looking at my October LES. I have LESs saved years back. And the portion of your LES that you're going to look for is the section labeled federal taxes. And you can see the wage period and then wage year to date. Like any good budget nerd, I also keep a spreadsheet of this as well, which is really handy when I was getting tax-free pay every other month or every month for a while, on and off. But right now, my wage year to date is exactly what the IRS thinks I'm going to make as far as taxable income before deductions and standard deduction and tax credits and all that. And you can see that it's my wage period basically times 10 so far. And you can take that wage period, add it all up, and figure out exactly what you think your estimate for your taxes are going to be for the year. Take out the standard deduction, and then you can start working back on what you think your tax bill is going to be for the year. And then on the Roth versus traditional debate, there is a special nuance of people who are really heavy in the financial independence, retire early, the FIRE movement, who intend to make zero income after they retire at 35 or something like that. And there's a good, very advanced model of doing traditional contributions, and then that taxable income being the only income you have in early retirement is no big deal because it's not going to get taxed at a high rate anyway. So if you're deep into the FIRE movement, then you're probably familiar with that. But for most people, we're pushing Roth right now.
That's right, Jamie. Don't buy a house on active duty and contribute to your Roth accounts. I think maybe we got another podcast idea there.
We got a bumper sticker. Spencer, it's going to be really awkward when I get an assignment in a couple of weeks. And I'm like, maybe I should buy a house in wherever I end up going next. You're going to have to talk me out of it.
Can't wait to counsel you on that one. Listeners, if you want to hear more about how to stop paying state income tax, you can listen to episode number 27 on the podcast. We also had a couple military spouse episodes. Kate Horrell, we talked to her in episode 119. And we had a military tax Experts Alliance with Paul Allen episode, and that was number 130. And if you got any questions, you can reach out to us, podcast@militarymoneymanual.com or Instagram @militarymoneymanual, and we'll catch you on the next episode.
Thanks so much for tuning in to this episode of the Military Money Manual podcast. If you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This helps others find the show, and we really appreciate it. Thanks again for tuning in, and we'll catch you in the next episode.
The views and opinions presented here are those of the speakers and do not necessarily represent the views of the DoD or its components. Reference to any commercial products or services does not constitute DoD endorsement of those products or services.